Welcome to the Bulletproof Cash Flow Podcast, the go-to place to gain financial freedom through real estate investing. Here we interview investors, mentors, and entrepreneurs who share their secrets and advice to help you build passive income. Let's get into the show.
Hey everyone, this is Augustino. Many of us in the real estate game got our start flipping single-family houses and small multifamily. As you can imagine, doing a much larger property like a big multifamily deal is a very different play. It's much more involved, but the upside is making this transition from single family to multifamily is significant. Well, today's guest made this transition and he did it in a very big way. He kicked off his real estate career in 2005 doing fix and flips, but saw it was difficult to sustain and really wanted true financial freedom. This is when he shifted his attention to multifamily and doubled down his efforts in a very big way. As the CEO of Kahuna Investments, he has managed and acquired over $100 million in real estate across the country. He's the author of the best-selling book, Why the Rich Get Richer, The Secrets to Cash Flowing Apartments, and hosts the Multifamily Legacy podcast. He's frequently featured on Fox, CBS, ABC, and NBC affiliates where he talks about all things real estate. With all that, I'd like to welcome Corey Peterson to the show. Hey, Corey, thanks for coming on. Appreciate it.
Man, thank you for that wonderful introduction. And man, I'm excited to be here.
Yeah, me too, man. It's going to be awesome. It's going to be great. All right. Well, before we go on, if you like what Corey has to say, you can reach him via his website at kahunawealthbuilders.com. So, okay, Corey, now go ahead and tell listeners about how you got your start.
Man, I started my dream almost 18 years ago. And here's what's crazy is it happened by accident. I was a used car salesman and a restaurant manager, barely made it out of high school. So I would just say I was not voted most likely to succeed. But something magical happened, and that was 19 years ago. My mom was married to this man named Bruce, and now I call him Bruce Wayne. Okay, he wasn't Batman. He's not Batman, but he was loaded. And my mom was married to him, and so he had a house in Hawaii. And me and my girlfriend, now my wife of 17 years, we got to go. And when we got there, we didn't know it, but Bruce had a house right on the beach. And I remember going to this house. We woke up early in the morning. We walked, it was on a cove. We walked the cove. We watched the sun come up, and it was like a magical paradise as the waves were breaking and the spray was, up in the air and the light hit it. And I mean, we were transformed and transfixed. And I remember looking over to Bruce's house, and I was like, what does this guy do? Because he had fine art, nice cars. His phone wasn't ringing. He didn't seem like he had a care in the world. And so I asked him, what do you do, Bruce? And guess what he said? He said, I do real estate and I own apartments. And so now I wish the story got better, but it doesn't, because Bruce is a prick. He was a grumpy old man. But I left the island thinking that Bruce was the big kahuna, because he had the two things, and it was undoubtedly what he had was time and money. Yes. And that's what I think we're all striving for. And so, about 6 months after going to Hawaii, I read this book called Rich Dad, Poor Dad, and boom, all I could think about was Bruce. That's what he did. So in 2005, I started my company, and I called it Kahuna Investments because I wanted to be the big kahuna. And so now, and like you just said earlier, I went on the journey. I did a self-assessment. I'm like, where am I at today, and what do I have? And, I said I didn't have any credit. I didn't have much money, but I had a really big will that I wanted to succeed. And so I started off as a wholesaler, right? I would go to local RIAs and find guys that were doing deals, and I would sit right next to them and find out what they wanted. And lo and behold, I'd go out and find a deal for them, right? And I'd get like a $3,000 or $4,000 wholesaling fee. And that was working out pretty well. And I was actually starting to get in the game of real estate a little bit. But the thing was, is I was managing all these guys' rehabs at this point in time. And, I was like, gosh, if I could only find like some private money or something, like if someone would just give me some money. And, because I was making that $3,000 or $4,000, they're making $25,000 or $30,000 rips on their fix and flips that I was doing all the work managing for them.
Yes.
And so Bruce was my first magic. The second magic that happened in my life was truly this next piece, which is called OPM, right? Other people's money.
That's right.
And this is where I discovered and learned how to raise capital. Because, see, I grew up a small farm boy from Missouri. And let's just say that my thought process on money and how I viewed money and how I viewed myself on it was not very high, right? We never talked about money in my family, right?
Right. Nobody does.
No.
Yeah, nobody. It's like taboo. Yeah, exactly.
But I know I need to find some private capital. So I'm playing racquetball with this older gentleman that I play racquetball with. He's kind of been watching me wholesale, right? And just watching my process. We share a lot. And so I didn't think he had any money, but he lived in a retirement community. I'm like, surely there's got to be someone in this retirement community who has money that maybe he knows. And so I asked him, I go, hey, like, Carl, you're watching me do these flips, and I could probably pay like 12% if you could find someone that had some money, right? And give him a note and deed of trust. And so he was like, well, yeah, okay, I'll see what I can do. And so the next day comes along, and all of a sudden I get a call, and it's from Carl. And Carl's like, hey, Corey, do you still want to do that 12%? And in the back of my mind, I was like, man, Carl found somebody. Yeah. He goes, Corey, you don't know this, but my home's totally paid for. I can borrow money at 3%. If you can give me 12, I make a spread. How much money do you need?
Nice.
And so at that moment, I'm like, I kind of raised everything. I'm like, this is a big moment for me. And now this amount doesn't sound very big, but at the time for me, it was. I'm like, Carl, I need $85,000. And he's like, yeah, okay, yeah, no problem. Yeah, where do you want me to send it? And just like that, I mean, my jaw hit the floor. And I mean, I was like, every limiting belief that I'd put on myself was instantly shattered. And so I like to equate it as I went into the telephone booth as Clark Kent. And I spun around that son of a biscuit, and I come out of there saying, I raised profit money! And it just gave me extreme confidence. But what it really did was open my eyes to the one thing that I think I do better than a lot of people out there, which is the ability to aggregate capital to fund deals. And so then once I understood and broke that limiting belief, I got, infatuated, just all in on the ideal of raising capital. And I started raising it for my single family fix and flips, where we were doing probably 6 to 7 flips a month, right? That's a lot of projects going on at a time. And I'm doing it all myself, like the typical fix and flip investor or wholesaler out there. It's a small operation and doing all this, but I'm starting to feel some pressure, right? And the pressure is, it's becoming a lot of work. I got a lot of moving parts, right? And there was a point in time where I was like, I would look at this point in my life, very, very, very successful, right? Anybody, you're doing 6 to 7 flips a month, you've got capital, but I'm going to tell you, this is actually my darkest period in my life. And it's because I have let the pursuit of money get in the way of everything else that truly, really matters, right?
Yeah.
It was not the cash flow life that I talk about, right? I was doing the hustle and grind to an extreme, where one day, Friday, my son looks at me and says, Dad, are you going to be at my soccer game? And I look at him and said, no problem, son, I'll be there, right? And his game was at 2:00. But inside, I'm like, man, all right, I got to go look at these 3 properties that I didn't finish up this week. So I'm going to wake up early Saturday morning and go look at these properties real quick, and I'll be back home, in time for the game. Well, long story short, I go to the first one. There's things wrong. Got to run to Lowe's. Got to do stuff. I'm just getting a little bit behind, and man, I end up showing up late. I end up showing up at the very end of the game. And the game's over, and my son comes off the field, and he comes right up to me, and he starts to cry. And he said, Dad, you promised. And just, you want to talk about breaking a man? Because he was, just that kind of sobbing, like I heard his feelings. And dude, it crushed me. It crushed me. And I'm putting him in my in my chest and, and oh my gosh, dude, it was the worst pain I've ever felt. And, I'm just like, what did I do? If I would have known this, I would have never done it. And so, kids are resilient though. Kids are resilient. And even though I hurt my son bad, he still wanted to jump in my truck and like me take him home. Right. So, and dude, that was even agony because we're taking him, driving him home and, and he's just trying to hold it back, but he can't. And I just feel it's agonizing on the drive. And I feel so ashamed that I let work get in front of being a father.
Yeah.
Right. Being a dad, being the things that are real. And I remember dropping him off and my wife looks at me and she's like, you got to make this right. You can't do this. And so I got back in my truck and I was just, because I needed some time. I was like, I'm driving my truck by myself, just like on a road to nowhere. And I'm crying, I'm bawling, and I'm asking God to forgive me, for being such an idiot and just beating myself up, right? Verbally, mentally. And I do that for a good hour, man. I'm just driving, I went, mindlessly on. And I finally get to a point where I ask God to forgive me. And I honestly, I forgive myself, right? And in that broken, humble spot, the next magic thing happens, right? Is I drove by an apartment complex. And it's the same apartment complex I've driven by millions and millions of times on my way home. And I used to say, I wish I could own an apartment complex. And in that broken state, humbleness, right? I just changed my thinking a little bit. I said to myself, how can I own an apartment complex? And I'm telling you, as soon as I said those words, it's like everything activated, right? And all of a sudden my mind like flashed right back to Bruce in Hawaii, time and money and the lifestyle. And I'm like, oh my God, this is the route. It was definitive for me that there was no doubt in my mind that it was the multifamily cash flow life that would set me free and allow me never to have this experience ever again. So I flipped to Yui. I went to Barnes and Nobles. Now we go to, iPhones. But back then I went to Barnes and Nobles. I bought $4 on multifamily. And actually the last one I read was Murphy's Law. The last one I read was one that I really connected with. And it was written by Dave Lindahl from Boston. And Dave actually became my mentor. And he taught me the business. And here's what's cool is that I learned it. And I finally got to the point where I was ready. And I got my first apartment deal. I bought it for $3.2 million.
Your first one's the $3.2 million.
Yeah.
That takes some courage. That takes some courage right there. It's good. I like it.
And I raised $1.4 million of private money.
Nice.
And so I sold that property 2 years ago. So I bought that property in 2011. I sold it for $8.8 million.
Wow. Nice.
I made $4.7 million profit on one stinking apartment deal.
Nice. Well, and you bought it at the right time, though. That was a good time to buy.
Well, I bought one 3 years ago that I'm getting ready to sell. I bought it for 3.6. We're selling it for 8.2.
Nice. Not bad. So, okay. So let's take a step back then. So now that you're raising all this capital, how are you doing that? And what model are you using? You use like a syndication, partnership? How exactly are you putting all those deals together?
Yeah, I do absolutely syndication every time, per deal, per project, right? And so here's what I realize that I'm doing a lot different than most investors out there is how I raise my capital. Okay. So I realized early on, as I look at different models, I was like, I didn't want to give up the bank. Why do I got to be a slave to the capital? And so I didn't tell you the full story, but before I got full-time into real estate, I was a financial advisor with Edward Jones. And they taught me everything about money, stocks, bonds, mutual funds, just how it works, how to network, how to be involved, and really how money truly works and how much money is really out there.
There's a lot out there.
I mean, there's trillions and trillions of dollars out there, and they're looking for solutions. And so when I looked at my life as a financial advisor, we're promising people 6 to 8%. Like that's kind of what, if you do a balanced portfolio, if you can make 6 to 8, that's a solid return year over year. We never say 12, right? 6 to 8. And that's what most people are trying to achieve in their IRAs. And so when I looked at that and I said, well, if I go raise capital, so we do a 6% pref, right? Meaning we give a 6% preferred return and we pay it quarterly. Okay. That provides income, and we sell our product based on income, right? When we talk to investors, I'm really talking about how I can give them an increase in their paychecks,
right?
Because they've saved all this money. And then what Wall Street doesn't do very efficiently is turn their savings into an actually good paycheck without touching principal, right? Because you think about what's out there that's safe, CDs, which pay nothing. And then, and then you go even to money markets, we pay absolutely nothing, and then bonds. Bonds are probably the closest that you'll get to, and that's usually average of 3 to 4%. So a 6% payer is almost doubling most people's paychecks.
That's right.
When it comes to fixed income, right? So, but wait, there's more, because with apartment investing, we have, that's usually based on cash flows, that preferred return. And then we have a sell event down the road, which we can give, which I do is I give a 6% annualized return. Now, notice what I just said is I didn't say a percentage as far as of the deal. My investors get a fixed return. It's 6% annualized or preferred, and then another 6% annualized for a total return of 12%. My investors will never make more than 12%, right? Now, what does that do for me as a syndicator operator? It allows me to make more profit if we kill it. Also, it makes a lot more deals qualify.
Yes.
And so I think that gives me a little distinct edge. We're still super conservative in what we do, but by raising money at 12%, instead of giving an unlimited upside, we have cut down the upside to where they'll only make 12. Now, that's better for me, the sponsor, okay? Now, last year, we raised $10 million worth of private capital using this strategy. So when people tell me, oh, you can't sustain that. Yeah, you can, right? All day long, twice on Sundays. Why? Is because people are looking for alternatives to the stock market.
That's right.
So I always say, what is this money and what is it not? It's not Wall Street. It's not REITs. It's not smart money and smart capital. It's your average people that are in IRAs that have a financial advisor. That's it. Those people. Those are your bread and butters that are just looking for a better return. Because if I compete against an IRA, I will win 85, 90% of the time. I feel like.
That's right. Now, those investors also get equity in the deal, right? Same sort of thing, or they just get a return. That's it.
They do get equity, but they don't get paid out any equity. So we define our payout. So they get when we do our splits, right? We have an A shares and B shares.
Yes.
A shares are limited partners. That's where all our investors go. And they get carved out. It's 50% of ownership. So the one thing they do split 50-50 with me is our depreciation.
Okay.
Right? Typically, we'll do what's called a cost segregation study. We just did a deal where we did a $10 million purchase, and we got a $3 million bonus cost segregation study depreciation in year one. And so my investors got 1.5 of that money, half. And there was actually 36 investors. Well, I say 36, but we raised 3.6 million on that deal. So if I did the math, 1.5 million divided by, if we had 36 investors that gave us $100,000, they got a $41,000 per person. For every $100,000 they invested, they got a $41,000 depreciation.
That's pretty good.
Dude, they're whistling Dixie, right? Now, if they're in the IRA, they don't get to use it as much. But if it's their cash money, that's a big deal.
That's huge.
It's huge.
Yes.
And so by doing that, so what we found is that if we give consistency in return, because what most people, they will not tell you this, but this is how people think, is they're willing to take less for consistency.
Yeah.
And so we really strive and pride ourselves on being very consistent on our process and being able to pay our returns, right? And because of that, and we've got a track record now. Now, I didn't start out that way, by the way. I didn't start at 6 and 6. But I think in this climate, you can. I started off, my first deal was just a percentage of the deal, 60-40 split. And I give up 40% of my deal, all of it, right? And now I still took 60, which is still, most people would say it was the other way. But I was still smart enough to say, I want to own more. And then I did an 8 and 8. right? And then I did a 7 and 7. And then I kept challenging. So number one, challenge your capital because you have to. I honestly believe you should challenge your capital. You're not doing it right if you're not. Yeah, you'll lose some investors out there, but you'll gain more. That sounds really counterintuitive, but I'm telling you, it's the absolute truth. You'll get more capital as you start lowering, because when you tell an average IRA investor that you're going to give 18%, what do they perceive that as? Risky business.
Yeah, risky. Exactly. Yeah. Or you don't know what you're doing either, especially in today's market. I mean, you can't tell people 18%, or hell, you can't even tell them 12% and nobody will believe you right now.
Yeah.
I mean, there's such cap rate compression going on and it's unbelievable. Yours is the least believable,
So
but
we start at 6.
yeah, right. But you built it on an actual, I mean, you have a track record too. I mean, that's what you're also selling, is that you're selling that consistency. And there's value in that. If you're just starting out, nobody's going to give you 6%, or nobody's going to want 6%.
No. When you first start out, be willing to do whatever it takes, right? So that's the real deal, right? So I was willing to do whatever it took in the beginning, right? When I'm syndication, I give up more just so I can be a part of a deal, right? Now, it happens that my first deal, what I was really good at was raising private money for single family fix and flips, right?
Right.
And that's actually how I call it the Corleone method, right?
I love it.
I realized that, now this is going to sound really strange. Guys, the money's not in real estate. I used to think it is, but it's not, okay? The money, the true money, the money's in the money. The Godfather, man. And this is so true, because how I found my first deal was not because I found the deal and it was underwriting. I went to an event, a multifamily event, and it was like a 4-day manage the manager event or something. There was about 150 people there. And on day one, they just like, this never happens, but it did at this event. They're like, does anybody have any announcements? I'm like, oh God, that's my cue. And I stood up in the back of the room and I go, my name's Corey Peterson and I got a crap ton of money and I'm looking for some deals. If there's any deals out there, come see me. Man, I didn't pay for lunch and dinner for the rest of the week, dude. And I had everybody's like, hey, Corey, look at my deal. Corey, look at my deal. Ooh. And all of a sudden it was like the Godfather came in. It's like, yeah, I don't know. Let me see. Let me take a look. And, I want to wet my beak. And what I realized, the money is always patient. The money always gets the last look. The money always negotiates out of strength. So the money's in the money, right? And it doesn't have to be your money. If you can aggregate capital and you can command it to go somewhere, that's very, very powerful. And
Yes.
So I was able to harness that in my single family book of business. I was doing my single family flips, and how I did it, the transition was really, guys, listen, it's getting harder to find deals. That's true in today's market. That was also true for me in 2010, because all I was doing back then was doing REOs and short sales from the MLS. And once that started to squeeze, I'm like, oh God, I got to find another spot. And so I'm letting my capital know, hey guys, it's getting harder to find deals. We're going to move over here to multifamily investing. And here's why. Because it's going to provide cash flow, stable returns. I'm like, listen, if you think about it, all you do is give me your money and I give it back to you. Give your money and give it back to you. Like, let's just stop the whole process and let's just give it to me one time and I'll hold it for like 5 years. And so they said, yeah, that's a pretty good idea. And it was. And so they humbly followed me. And it really is because we had relationships.
Yes.
That's one of the biggest part of raising money is it's always done one-on-one. Wouldn't you agree?
That's right. Absolutely. Absolutely. It's still a people business. You're still getting up in front of people. You still have to build their trust and win their trust in order for them to actually throw money your way. And part of it is, again, they have to recognize you as someone that does this for a living, right? Or have someone on your team.
And if you're not, go find someone that is and say, listen, I want to be part of your team. I want to go aggregate capital.
Exactly.
See, even in my education process, like people that become my students or whatever, I'll share with them my credibility kit, right? Well, I'll put their logo, their stuff on it and help them go out and aggregate capital because why? That's very valuable for me. I'll give them ownership of my GP if they can aggregate capital. So money is valuable. Finding a deal, not so much. Finding a deal is great, but it probably doesn't pencil, right?
That's right. There's plenty of them out there.
But if you go find me money, listen, we're going to have intimate talks. Like that's very, very valuable. So on the pendulum of what's valuable and what's not, raising capital is extremely valuable. And it's the one thing that when I go to, I belong to a lot of single family things, right, as well, still, mastermind groups and stuff like that. And I'll say the biggest factor between my success and these guys' success, and I want to be humble here, right? Because I'm a multi-millionaire when I started doing apartments. I've always made a good living doing single family fix and flips and wholesaling. But I became on paper bona fide when I jumped into the multifamily place, right?
For sure.
And where I have cash flow coming in that happens without me doing anything at all. That's magic. It is very, very special. And so I guarantee my net worth is a lot higher than a lot of these guys in these high level masterminds that are big operators. And the challenge and the difference that I see, that the one thing that I did different that they have not mastered yet is that one thing, the ability to raise capital. It separates the boys from the boys.
Yeah. Now, maybe you could talk a little bit about that. Do you have like a set process? Do you have like a step-by-step thing that you actually do when you approach somebody? Like how do you do it? I'm just curious.
Yeah. All right. So yeah, I'll get some training. This will be fun. So number one is when I was new. So because I started off and I raised all my money by accident, right? With Carl. Started with Carl. I really did something special with Carl that I didn't know it. But rule number one, you never ask people for money. You only ask who do they know, right? When you're starting out and you're green, never ask people for money. Only ask who do they know. Why? You're going to take all the pressure off when you do this, right?
Yeah.
Now, and then you're going to ask them to critically look at your presentation and poke some holes in it because you want to make sure that they feel really comfortable referring someone to you. Now, what did you just do? You took that person that you want to get money from, but now you're saying just, hey, I don't want you to refer me to somebody, but I want you to critically look at my thing, my sales packet, my marketing packet. Well, now he's really paying attention. And I'm telling you, the right people will always self-select. They'll read this thing and they're like, well, hell, I'm kind of interested in that. Well, oh yeah, I would love, I wasn't going to ask you, but if you want to give me some of your money, why don't you put your foot in the pool? But let's go to the beginning real quick. So I'll give you guys some nuggets. So when you're raising capital, you got to start learning how to have conversations about money. Okay. And now I am telling you, I'm not the smartest tool in the shed, but I am a great and master copier. And what I'm going to teach you now is what I learned when I was a financial advisor. Okay. This is what they taught me, is that you've got to have conversations about money. And that's very uncomfortable for a lot of us. But here's how it works. Let's say you had a Chamber of Commerce meeting, right? And they have that 30, you got 30 seconds, go. What do you say you do, right? Now, first of all, if you say you're in real estate, wrong answer, okay? Because once you say you're in real estate, everybody thinks you're a what? You're a realtor, okay? No,
exactly.
We're not realtors here, okay? We are I'm not saying we're better, but we're just, we're operators. And that gets you nowhere once you say I'm in real estate, because there's blind, deaf ears. Everybody's a real estate agent, okay? So how about saying something like this? Corey, what do you do? I buy apartments across the United States that provide my investors with a nice return and a strong back end. How's the market treating you? Now, the most important part of that whole thing was the question.
That's right.
How's the market treating you? Once we go down that road, what are we going to talk about? There's only one way you can answer that, right? We're going to be talking about what? Money. And talking about money is how you get to the subject of I raise capital. Now, from there, I always say, like, the goal of any first meetings is to not, and this is what most people do in the beginning, is they vomit, right?
Yes.
They have this thing, they've learned all this stuff, they went to some courses, right? And they all of a sudden like, oh, blah, 12, and they're screwing up a lot of security SEC laws, because there's rules to raising money, by the way, guys. especially when you're pulling large amounts of capital together. And there's right ways, and I want to tell you the right way to do it. So in the beginning, we're going to have this conversation and we're trying to have some dialogue. So if I ask you, how's the market treating you? And then I'm going to be very interested in you and what do you do? Where are you from? And if I keep on asking enough questions, if he's the right person, eventually he's going to do what? Ask a question about me.
Yeah.
Well, how do you do that money thing? 12% return. What is that about? And I'll have a short discussion about apartments. Well, we buy these old 70s and 80s apartment buildings. They suffer from two things, bad management and deferred maintenance. And we're able to fix those two things pretty well. When we do that, we get to make a lot of return, and we actually get to increase the rents. People can understand that. In their mind, they're starting to see that vision take shape.
Yes.
And then you kind of let it go. And then you start asking them, again, you got to go back and ask, well, what's your favorite investment, right? And you get them talking. Because if you talk too much, you're screwing up. Finally, because I just piqued their interest with what I said, and then I asked them another question. Well, they're going to come back and fire back away. Now, usually after this happens a couple times, now you got to do what I call the Heisman, okay? You have to Heisman them. And that's when you're going to pull away because it's now time to be intentional. And so from that point, because the goal of any face-to-face meeting is to truly set a real meeting to where we have a specific conversation about what we do.
The follow-up. Yep, that's right.
And so, and someone starts having more questions, like they seem really generally interested, I'll be like, hey, John, listen, you sound to me like you're really interested. Can we do this? Can we be intentional? And I love saying that. Can we just be intentional? Listen, how about let's set a appointment next week and let's have some coffee. And let me share with you, a lot more in detail about what my company does and how we help investors like you make money. And then we get off the subject, right? And so then we do it right there. I'll be like, pull up my calendar. Great. What time works for you? Let's set it up. And then now we just went from I shook a hand to now I'm having a real appointment. And I get to talk about money. And then at that appointment, I'm bringing what I call my credibility kit. And my credibility kit is that we don't talk about numbers or anything to do with projects, but we talk about what we do in apartments, right? And it's just a nice little brochure that we get to talk and share the kahuna story. And what the goal is, hey, listen, at the end of that meeting, I also bring another form, which is called my accredited investor form, right? And so at that moment, I'm going to, we met, now I'm having a conversation about what we do as kahuna in a whole. And I'm going to get them to say, listen, would you like to see some of our deals? Would you like to be and see our deals, future deals? Well, yeah. Okay. Well, then I need you to fill out this accredited investor form, right? And so they fill it out. And then we have right there a discussion about that form, right? I got to have a substantive relationship with them. I've got to ask them financial questions. I got to know what they are doing with their money and how experienced they are. And after that, we've documented this process, right? Then we can take that back, and usually we'll wait a couple more days before we even show them any deals or potential deals that we have coming forward.
Nice. And you're qualifying them too. That's very important, even for the SEC rules, right? It's, it's very similar to what we do. If we get if I'm talking to a person and they start asking me questions, first meeting, I'll say, you know what? Can't really tell you too much more. We follow the SEC guidelines. If you want, we can set up a meeting next week, get a coffee, and talk about it at length. Then, that kind of thing. And then, exactly, beautiful way to do it. Beautiful way to do it.
And really, that's just the technique. It's no harder than that. And it starts with friends and family. You're like, well, and a lot of people, my friends and family don't have any money. Well, neither did mine, right? Neither did mine. But guess what? It's a great place to practice. It's a great place to get the words out of your mouth before you actually have a real live investor that's going to give you money.
That's right.
And believe it or not, everybody knows other people that have money, even your friends and family. Trust me.
Friends and family know they know somebody, and whoever they tell, they know somebody too. So, but you're right. Getting up in front of, I think that's what it is that they have to break that paradigm in their mind that they're like, nobody has any money, so I'm just going to stop. I'm not going to do anything, and then just sit back and wonder what to do next. It does take that action to actually start talking to people and engaging. That's ultimately what it is.
And the best thing about capital is it becomes a snowball effect, right? That it avalanches. And really that's the right word for it is man, when you start as little, you get one or two people, and then all of a sudden they tell two or three people, and it just becomes this ginormous thing that's rolling down, that they become your tribe, and to where you can command it to go wherever you want. That's the beautiful thing about this relationship building process, is these becomes your friends and they trust you. And they always have more money too, by the way.
That's right.
They always have more money.
That's why you absolutely never lose your investors any money at all. Never. You take it out of your own share and give it to them before you lose any of their money. If you take down a bad deal, or a deal that's not going as well when you're first starting it up, right?
Yep.
Because they always have more cash, and they always have friends that have more cash. You always do them right, the money will come right back to you.
Yep. That's the absolute truth.
Yeah, absolutely. So if I heard you right, then equity side is 50-50. Right? Equity is 50-50. And then at the end, you do a refi, I imagine, right after 3 to 5 years or something like that?
A typical strategy is to hold for 5 years. We always say it's, year one is to fix all the broken stuff. Year two is to fix all the broken tenants. We want to upgrade our tenant base. And then we want 3 years to maximize operations, right? When we maximize operations, that's where we're going to try to grow our rents as high as possible and keep our expenses as low as possible. When we do this, it's a perfect recipe for success. And then we'll exit. Typically, we will refi, meaning we'll use the appraised value of the property, and then we'll refi out our investors, and we'll buy. But theoretically, we buy out their shares. We have a buyout clause. They exit. All we still have to do is pay them that 12% total, and they're gone. Okay. Or if someone gives us a stupid amount of money, like at a 4 cap, we're going to sell it, because we can go buy something at a better cap rate and arbitrage that difference as well.
Yeah.
Unless it's a really nice asset that we would like to keep. So I've got a couple of properties that are built in 2006, right? We're probably going to keep those assets because they're, it'll be hard to replace that asset.
Right. Where are you buying exactly? Or do you have a preferred place? I know you're buying nationally. Do you have a preferred area? Like where are you looking?
The Midwest and the South.
Yeah, where everybody's looking.
So we underwrote 721 deals last year. Full, I'll call it almost a Wall Street grade underwriting.
Wow.
Multiple tabs, multiple stuff that we look at. We did 16 site visits. We put in maybe 9 offers, maybe 10 offers. We transacted, my group that we worked with transacted on 6. I actually own 3 of them.
Wow.
So 700 to 6, right? Truly.
Yeah.
And right now in today's market, that's how we're kind of just being very selective, because dude, there's lots of crazies coming into this market right now, and people that have truly no formal real training. There are a lot of fix and flip investors that have not been through very good training procedures or systems, or being very conservative. So, man, we say no so much. People are like, well, it's a deal. I'm like, no, it's not. It's not a deal. Like, Corey, I'm doing the deal. Well, I'm not doing the deal. So, because we just say no a lot. But when we do say yes, it's a deal, right? The deals that we are doing are great deals. And I think that's, not to say that there's not lots of deals out there, but we're super conservative. I take that money part very seriously. When I'm raising, $5 million for a project, man, I got to sleep like a baby at night. And I've had a deal, my second deal I ever done is not the great story. It's one that I had sleepless nights for 2 years because I was wondering if I was going to, in fact, all I was able to do is give my investors their money back. For 2 years, you want to talk about sleepless nights? Man, I'll never forget that story, or the pain, and having to have those conversations.
Yeah.
Never.
But you know what? There's many investors that actually value that kind of stuff too. I mean, there are guys that'll say, "Oh, I never screwed up a single deal ever in my life, ever," and it's like, yeah, I don't know. I mean, but to say that yeah, you know what? Yeah, I got my investors' money back.
It cost me $150,000 to give it all to them.
Yeah,
right. It cost me money.
It cost you money, exactly. But you gave it back to them. Yeah, that's the point. And you only had one.
And and half of them came back and reinvested in the next deal. The other half were truly the new people that just never been with me before. They'll never come back. So when you said you get one chance, right?
Yes.
You get one chance with capital. And so for those new people, man, I'll never see them again. And even though I've had a great track record since my second deal, right? But because I got burned on that first one, and that's, the second deal I ever did, I realized that, man, I will never bend on any of my, what we call our underwriting guidelines, right? Because we have to be able to sleep like a baby. Having worry, when you have $2 to $3 million that you're worried about, it's a reason to go gray fast or lose your hair.
That's right. That's how this happened. No. Yeah, and that's the thing, though, too. Right now, finding the deals, underwriting great deals is tremendously difficult. Well, underwriting is easy. It's finding the right deals is difficult right now.
Yeah.
I mean, I get emails from these guys all the time. They're talking stuff built in the 70s with hair on it at a 4 cap somewhere in the South. It's just I can't even make sense of it. It's like there's no way it'll even work, and someone's buying it.
Brokers should be shot, dude. Brokers think it's crazy. But you know what? The property that I'm listing for 8.2 is at a 4 cap. I have 4.7, right?
Yeah.
Because there'll be somebody stupid will buy it, right? I'm telling you. So it's the seller's market, right?
Well, right now, though, it all depends. I mean, if it's already stabilized, it's already cash flowing, and a hedge fund's got the cash for it, they don't mind taking it down. They would love to do something like that. Here's the secret to selling at 4 caps, because my last 2 properties I've sold at 4 caps. Okay. What Wall Street loves is a nice, steady, rising income, and steady being the key word there, right? And they like to see collections. So for us, collections happen by the 5th. But 99% of our money is collected, honestly, by the 1st, right? Because we use ACH process, right? Mm-hmm. But most of our money is collected so quickly and accounted for. That looks good on our financials. Occupancy on this particular property, we've never been below 97% ever in the 3-year history that we've owned it. Nice. Right? Yeah. And so again, that just all it does is look like a nice, steady, rising income. And that's an easy button for Wall Street, or a broken 1031 exchange, or, a small family office. They're looking for places to put money that can give them just a nice, solid return. Because they're not going to use the bank. They're just going to fund the whole thing themselves and get a coupon clipping out of it. That's right. They're just trying to preserve capital. Now, do you build all that into your marketing material then when you go to sell it? All those certain points? Are you targeting those buyers? We make a really nice marketing packet, but then we individually ask and try to we do some direct mail marketing to broken 1031 exchanges, right? And say, hey, here might be an opportunity. But we don't even put the price. I mean, like everybody else, we don't put price on it. We just say, here's our numbers, and here's the consistency of it. And, then there's a whisper price that goes out. But we've just been very, very good at telling that story. And when you tell it right, and all your team members can tell that story confidently, even at the property level, it's very convincing when people get there, like, wow, this thing's really humming and really very turnkey. Yeah. It all comes back to that consistency you mentioned earlier. Yeah. It always comes back to that. And if we don't sell it for that price, then we'll just keep it because it makes money, right? Right. Exactly. It's always an experiment. So now the good thing about guys like us is that we've actually been through a couple of cycles already, right? Yep. What are you seeing right now in terms of a cycle? When do you think there's going to be another correction coming up here soon, or do you think it's going to be a little bit? I think it'll be a little bit. I don't think it's coming up soon. I think it may be a couple years from now. I mean, we're hoping that it comes sooner. I mean, I'm telling all my investors too, there's a day that I'm going to say red. And that's the day it's not going to feel like it's the right time, but you're going to give me all your money. And I'm hoping that day comes sooner than later. But at the end of the day, I'm okay with where we're at right now. We're just being very selective in the deals that we get. We're buying them based on cash flow. We're not taking very big projects that need a lot of lift, right? We want to find, right now, we like 88%, 90% occupied properties that we can either cut some expenses or provide some value add there and raise rents just a smidget. We're very conservative on our raise. We want momentum plays based on cash flow right now. Nice. And then we strap them with long-term debt, usually 10 or 15 years debt. So when we get to that place, if there was a downturn, we can cash flow out of it, right? So our loans are not being called or anything due, and we just write up the cash flow
And we're buying this stuff in 70s and 80s buildings. So the downward pressure of a downturn in the market, I think, will have people moving out of the Taj Mahals to move into our affordable housing.
And that's why I tell people, because we do the same thing. All we focus on is C-class properties too. That's it, for the exact same reason. People are not going to be able to, or won't want to sit in their beautiful B's and A's. And you know what? They want to save a little bit of money. They're going to go down to a nice C-class. It's still nice. It's still safe. It's just not the same, but it's all right for temporarily.
Clean, safe, disciplined properties. Discipline for us is a big word. And like, our managers live on site, our maintenance guy lives on site, and our manager lives on site. We believe in disciplined properties, and our tenants expect that. And in any tenant base, B, C class, whatever, there's the cream of the crop, right? So our average credit score for our C properties is like 678.
Wow.
Well, how do we get that? By having clean, disciplined, safe properties that is workforce housing. It's not Section 8. There's a group of people out there that have great credit scores. They just don't make a lot of money. That's the people that we want in our apartments.
Yes.
And we're really good at finding them.
Yeah, excellent. And that's a big part of it too. That's a whole other show too, right there. That's a whole other show. Finding tenants. That should be the next one. So now, what do you see the next 5 years looking like for your business? I know you touched on it with the economy, but what do you think as a whole as for your business next 5 years?
Yeah, Corey Peterson wants to do 2 to 3 projects a year. I don't even count the doors anymore. I like projects. 3 projects is like 1 per trimester, right? That's an acceptable place for me to go. And if I do that 5 years in a row, that's kind of my goal, right? I like to work. I don't want to work extremely hard. I like the pace of 3. I could probably do 4, but that's really it. I mean, it's not any more exciting or harder than that. 3 to 4 projects a year, consistently every year for 5 years, and at that point, all I do is I think I'll just be doing bigger vacations.
Nice,
right? And again, doing a lot of traveling, and honestly, my goal is to get my kids. My kids are just getting ready to get into high school. So, 5 years from now, they'll be in college, maybe, starting to get out of it. My goal is to be able to hand off something to my kids where they can say, because, on that 6th, 7th year, like every year now, we start saying, what are our deals coming due, right? That are at maturity now, that 5 years. Well, that's the money we're going to reinvest. Like, so we already have money coming due that we're going to pull out. That's money is going to go into another deal. So now we don't really need a lot of new capital. And eventually my goal is to become a family office, believe it or not, right? To where my kids are going to be running my deals and running our own money, where we're not investing and getting any investor capital. That's probably a 10-year goal, but I'm going to try to do it in 5 if I can.
Are you training your kids right now on the business then? Are they're actively involved? Or?
They've been getting trained since they've been wee big, right? So we talk about money and kahuna and all stuff, apartments and investing. It's ingrained in them whether they want it or not. But truthfully, I think that they've not formally started full-time, right? And even part-time. And I want them to enjoy their lives now. And I already said, Dad has a spot for you if you want it. And if they don't, that's fine too. But I think they'll come to see that Dad pays pretty good, and that they're very proud of what we've built, right? And our brand. And I think that that goes a long way.
Awesome. All right, guys. Well, if you want to follow up with Corey, you can reach him at his website at kahunawealthbuilders.com. Don't forget to check out his book and the podcast. I'll include the links in the description. I hope you got a lot of great insight on how to raise money, which is a really big deal when you're trying to do this kind of stuff. Thank you so much for your time, Corey. Greatly appreciate it.
Thanks, brother.
Thank you for listening. We hope you enjoyed the Bulletproof Cash Flow podcast. For more free podcasts, articles, videos, and resources, go to www.bulletproofcashflow.com.